Most traders think candlestick patterns are the key to trading success, but if you've studied ICT, you know, it's not about patterns, it's about reading what a candle is really telling you. In this video, we're going deep into how professional traders and smart money read candlesticks, from liquidity wicks to rejection candles to using ICT tools like order blocks, Fibonacci, and session timing. You'll learn how to truly understand candlestick behavior and how to use that knowledge to level up your entries. Let's get into it. Why ICT doesn't teach patterns. Let's be real, classic candlestick patterns like the doji or hammer are everywhere, but ICT doesn't rely on those. Why? Because they ignore context. A candle is more than just a shape, it tells a story. The open body, wick, and close all give you clues about who's in control, where liquidity was taken, and whether price is likely to continue or reverse. It's not about memorizing shapes, it's about understanding behavior. A candle body tells a story. The wick makes the damage. One of ICT's most powerful teachings is this. The body tells a story. The wick makes the damage. Think of the body as where the market agrees, but the wick, that's where the manipulation happens. Long wicks usually mean one thing: liquidity was taken. This often happens near equal highs and lows or stop loss clusters. Smart money drives price into these levels, grabs liquidity, then reverses. If you only focus on the body, you miss the real move. Rejection candles at key levels. When you see a candle with a long wick and small body, especially at a key level, that's a rejection candle. These often form inside order blocks around previous highs, lows, near supply or demand zones. It's the market saying, we reached into liquidity and rejected it. Alone, it's not a signal, but in context, it's powerful confirmation. Candle opens and closes matter more than you think. Here's something most traders miss. The open of a candle, especially on the daily or 4-hour, is often a magnet. Price loves to return to these opens. ICT calls them points of institutional memory. The close also matters, especially when price closes above or below a liquidity pool or within a fair value gap. These aren't random numbers. They show where smart money left their footprint. Displacement candles equal market intent. When you see a large body candle that breaks structure and leaves a fair value gap behind, that's called displacement. It's the market showing intent. The smart money is behind the move. If price returns to that FVG and respects it, that's where we get high probability entries. Big candles mean big players are involved, but only when there's context. AMD inside a single candle. You've probably heard of the AMD model, accumulation, manipulation, distribution. But here's the secret: you can spot AMD inside just one single candle. The small range at the open, that's accumulation. The sudden wick, that's manipulation, sweeping liquidity. The strong close, that's distribution, the real move. Once you start seeing this, candles start to make sense, not just look pretty. Combining candlestick behavior with ICT tools. Now here's how we really build precision. You combine candle behavior with ICT's key tools. 1. Fibonacci retracement. Look for rejection candles inside the 62% to 79% OTE zone. Bonus points if that candle has a long wick into liquidity. 2. Order blocks. If you see a rejection candle forming inside an OB, it's not random. It's a reaction to institutional price. 3. Session timing in London. Kill zone wicks often sweep Asia highs, lows. In New York, watch for displacement and continuation. When these tools align and the candle behavior confirms it, that's your edge. Let's break it down on a chart. Price forms equal highs during Asia. London session sweeps those highs with a long wick. A displacement candle breaks structure. It leaves a fair value gap behind. Price returns to the FVG during New York. A small body candle with a long wick rejects the OB. That's your story. The candle tells it all. And your entry is based on logic, not luck. Every candle has a story. And when you know what to look for, the wick, the body, the open, the close, you start to think differently. Combine that with ICT's tools and you stop guessing. You start trading with precision, context, and confidence. If you want more deep dives into topics like fair value gaps, rejection wicks, or AMD plays, then let me know in the comments. Don't forget to like, subscribe, and share this with someone who's tired of guessing at candlestick patterns. You're learning to read price, not chase it.